Welcome back to the Dividend Diplomats YouTube channel. You got your boys here, Lanny Bert, the Dividend Diplomats. Whoo, buckle up. Today, we are going to talk to you about a stock that has just gotten beaten down so far in 2024. This stock is down 21%, and that is why this stock is shooting up my watch list and may be an undervalued dividend stock to buy. Oh, yeah, with a yield of over 4.5% today.
Ooh, smash the subscribe button, guys. Give us a nice thumbs up. It only takes 10 seconds, 3 seconds, 2 seconds. Click it. Let's ride with your boys here, the Diplomats. Bert, this is a stock we haven't featured in a while. This
Hmm.
stock has gotten their ass kicked in the last, couple months, the last 52 weeks. Had a nice ride up, but they have taken a hard fall from grace.
Yeah, stock is like Seth Rollins at WrestleMania both nights, just taking a beat down from Mr. Market. This stock, yeah, we talked about this in what, 2022, Lanny? We
Couple
bought
years back,
some.
couple years back.
Yeah, you found this one. We talked about it. We rode it the wave up to about 30 per share, held on. Now this stock's trading at 18.91. Guys, today we are going to talk to all of you about Spartan Nash, ticker symbol SPTN. Whew.
Spark Dash, guys. They are in the consumer slash grocery slash, you know, food industry here. And Bert, correct me if I'm wrong, but some of their major contracts and major consumers have to deal with the federal government, right?
That's right. Yeah, they have the government, they have groceries, and then they have a wholesale division too, which are the three big reasons. And that's ultimately what jumped out to us about Spartan Nash that separated themselves from other food distributors. They weren't ever dependent on one source of income to drive their sales. They always had a few levers they could pull if times turned tough in one of them.
Yeah. So, I mean, at the end of the day, they sell food to an end consumer, whether that's through a grocery store, whether that's direct, wholesale, directly to, some form of government entity. They sell grocery goods, guys.
Yeah.
Um,
Yeah.
and, this year they're down 21%, guys. And stock's down 24% since this time last year.
Yeah.
And, a few key pieces have happened through the most recent earnings release. Brett, I know you have a few tidbits of information with what Spartan Nash, had relayed in that earnings release.
Yeah, they had a slight earnings miss in Q4 for the earnings. And that was the downside, but the big news was they had actually positive year-to-date results. That was kind of the one thing that jumped out. They had $9.7 billion dollars in net sales. That was about a 1% increase. $52 million dollars in net earnings, a 51% year-over-year increase, and 257 million adjusted EBITDA, which is a 6% increase over the last year. So it was positive when you're zooming out and taking a look at 2023. And that's the thing that jumps out at you. They keep talking about a rebound strategy, what their growth strategy is, and it's really focused on that EBITDA growth. That's the one up the adjusted metric that keeps growing, and that they keep talking about wanting to focus on their growth, so they continue to achieve that a 6% growth rate in that with that adjusted EBITDA in a high inflationary period for a food distributor company is pretty solid.
Yeah, that's a great increase, guys.
Mhm.
They're approaching for their guidance about $10 billion in sales. And they're estimating in between that 255 to $270 million in earnings before interest, tax, depreciation, and amortization. For those that don't know what EBITDA actually stands for, guys, nobody here or rarely breaks that down, guys. Essentially, they're taking out all of the, I guess you can call it non-cash, items or that, depending on which way you look at it.
Yeah, that's right. It's funny. It's when you get one of those coffee mugs that has EBITDA written on it, one of the cheesy accountant ones. Actually, I'm kidding. I'm not going to get one of those. So with that, I thought it was interesting. The question is they view themselves as like the wholesale in the government in one entity, the retail in the other. How much of the 9.7 billion goes to which entity? Wholesale, $6.9 billion dollars in sales. Retail is 2.8 billion. So a lot of the revenue comes from these distributions. And the one interesting thing on why their price has dropped so much this year, not only are they facing pressure from inflation and from consumers, they what the earnings release said without getting into too much detail about numbers in some of the articles was that they had lower demand from some of their Amazon customers. So one of their major wholesale clients is Amazon in the distribution. So there was less food demand on Amazon for that. And I thought that was pretty interesting. So if wholesale makes up nearly 7 billion of their 9.7 billion in sales, if they're going to have issues with one of their key customers in Amazon, you can see why sales aren't projected to grow during 2024.
Mm. So with that, we are going to run this dividend stock through the Dividend Diplomats stock screener. We will look at Spartan Nash, their price to earnings ratio. We will look at their dividend payout ratio. We will look at that history of growing dividends. And Bert already said it in the intro. We'll look at the dividend yield, which is above 4.5%. Guys, is this a stock to buy right now? As this, we're facing a little bit of turbulence with where the Fed is going on interest rates, and obviously higher interest rates for this company who is saddled with some good long-term debt doesn't bode well for any business if rates stay higher for longer. So clap your hands. Thank you, US economy, for continuing to spend like there is no current tomorrow, guys. But if you happen to spend like there's no tomorrow, please buy some Spartan Nash goods as we go through this dividend stock analysis for this stock to buy.
Yeah, so their price as of April 11th is 18.91. Their forward earnings per share from Seeking Alpha is $2.01. That's a PE ratio of 9.41. So well below the S&P 500.
Whoa, easy there, Birdie. Um, Gosh, man, 9.41. Is this a yield trap already coming up? Is this an earnings price to earnings trap we're seeing right here?
Let's look at the
Um,
payout ratio and find out. Their annual dividend is 87 cents. That's a payout ratio, 43%.
Very safe, under 60%, in that sweet spot of 40 to 60%. Now, Spartan Nash does have a history of growing your passive income here, guys. They've been growing that dividend for 13 straight years. Lucky 13, about to make it 14 with that dividend payout ratio. And they've been doing it, though, only at an average rate increase of 3.39%. And Bert had a nice note here. The last increase was 1.2%. So definitely below the current pace of inflation.
And not surprising given a lot of the news we read about them in the earnings release and a lot of the facts, you would expect slow earnings growth until you start seeing more growth throughout the rest of the business. And as we mentioned, that yield is 4.6%. That's 60 basis points above their 5-year average dividend yield of 4%.
Nice. Yeah, well above that 5-year average, 60 basis point of margin there. They're positive on a 5-year growth, from a stock price standpoint, but again, really have gotten their, a mud hole stomped in them in the last, 52 weeks, especially these last few months, really, really carrying the weight with their stock price getting pummeled for that matter. Spartan Nash, guys. That was Spartan Nash's stock metrics. We're throwing up here on the screen again a 9.4 PE, 43% payout ratio, 13 going on 14 years of growing dividends with a yield of 4.6%, which is probably close to or near that high yield savings account all your money is parked at.
Yeah, so what are we thinking here with Spartan Nash? It's not bad. The metrics aren't looking terrible. When you see stocks like this, what's going on? I think what it jumps out to me is how that payout ratio continues to remain low. So you have a 43% payout ratio. If I saw a 9 PE ratio, even a yield like this, with a payout ratio that was 70, 80%, I'd be much more concerned. But at least with the low payout ratio, the dividend's safe, albeit, it's not going to be growing very much. So I think Spartan Nash has at least earned a spot on my watch list. And for me, it's more in the camp of not throwing the boat at it, but this might be a good time to maybe buy 5 shares, 10 shares, lower my cost basis in my position, and get a larger dividend in a position that I already own.
Yeah, I mean, 5 shares is under $100.
Yeah.
I could totally dig it. Yeah, I can't argue there. Um, and they could be a perfect, acquisition target as
Mhm.
well for somebody
Yeah.
who really wants to be a good foot in that position with those larger contracts, that foothold with Amazon, especially if they're earning close to $7 billion in the wholesale segment. We've got a lot of, I think there's just upside, if that's what I'm trying to say, is that merger target or you have a appreciation target from what again we had seen a few years ago. So
Yeah.
yeah,
So do your own research, see what's going on, and see if it's earned a spot on your watch list like it has on mine and possibly on Lanny's too.
yeah, I'll definitely keep my eye on it. Guys, let us know what stocks you're buying. Is this a stock to buy to grow that passive income, guys? That's what we do. That's what Bert's doing here, guys. Bert is smashing in more income, trying to get to financial freedom like we all are trying to do here. So let us know definitely below. Hit that subscribe button. Like the hell out of this video.
And remember, if you're not with us, you're against us, Jack.
That was Bert, the Hurt, and Lanny from the Dividend Diplomats over and out.